Last week, U.S. natgas futures fell about 3% to a two-week low on Friday due to increased output and forecasts for lower demand once the current heat wave subsides. The price drop occurred despite a smaller than usual storage build for the sixth consecutive week and forecasts predicting more hot weather next week. Analysts noted that recent storage builds were smaller after some producers cut output earlier this year due to low prices. Currently, higher prices have led some producers to resume drilling. The U.S. Energy Information Administration reported a storage increase of 71 billion cubic feet for the week ending June 14, close to the 69 billion forecasted, compared to 92 billion last year and the five-year average of 83 billion. Additionally, the total rig count continues to decline, indicating a bullish longer-term outlook. Baker Hughes reported the total rig count decreased by 2 to 588, with the natgas rig count steady at 98, down from 130 a year ago. Meteorologists expect hotter than normal weather across the United States until at least July 6, likely increasing gas consumption for air conditioning. Meanwhile, gas output in the U.S. averaged 98.2 billion cubic feet per day in June, up from a 25-month low of 98.1 billion in May, but below the record high of 105.5 billion in December 2023. Analysts forecast U.S. gas demand, including exports, will rise from 97.9 billion cubic feet per day this week to 103.8 next week, with hotter weather, then drop to 102.8 in 2 weeks as the heat wave breaks. Given the current market conditions, a short-term bearish outlook is likely to persist. Strong production levels, increased flow capacity, and mixed weather demand suggest that professionals will likely continue selling during price rallies. The closest support level is a short-term pivot at $2.80, followed by intermediate support at $2.70, which is just above the 50-day moving average of $2.60. This indicates that prices could stabilize around these points if they continue to drop. On the upside, the key resistance level is at $3. This level is significant because breaking through it would require additional catalysts, such as unexpected weather events or significant changes in production. These additional catalysts are necessary to push prices beyond this resistance. Without such factors, surpassing the $3 mark will be challenging in the near term. If Monday's forecasts don't predict extreme heat into mid-July, I expect gas prices to decline next week due to lower demand from milder weather. Please like, subscribe, and comment to support the channel. See you in the next one.